Good morning, everybody. Thank you for joining us this lovely Wednesday morning. My name is Andy Umbach, and welcome to the Economic and Market Update for the third quarter of 2024. Certainly, despite some weakness at the headline level, underlying U.S. economic momentum remains solid in the first half of the year. At the same time, progress on inflation has been very slow, while the labor market has continued its gradual normalization. Moving forward, a resilient consumer should allow the U.S. economy to sustain a soft landing into next year. However, with still elevated geopolitical tensions and an upcoming U.S. election, risks remain that are worth monitoring, certainly. Meanwhile, sticky inflation has forced the Federal Reserve to reassert its hawkish tone. At this June meeting, the Fed's updated dot plot showed that it expects to deliver just one rate cut this year, down from the 3 rate cuts that they projected in March. That being said, while they have delayed rate cuts, the Fed has begun to slow the pace of quantitative tightening. Elsewhere, other global central banks have begun to ease their policy, and a widening gap in short-term interest rates between the US and other major developed economies could maintain the US dollar in an elevated position for some time to come. Bonds have rebounded after a challenging start of the year, while equities have maintained their upward trajectory and notched multiple new all-time highs during the second quarter. Moving forward, broadening earnings growth should support a more inclusive stock market rally, while investors may want to use this extended period of higher rates to lock in attractive yields on fixed income or bonds. Outside of traditional markets, alternatives can help better prepare portfolios for challenges that may lie ahead, whether it be through enhanced income, alpha, or diversification. The Guide to the Markets, now in its 20th year, just like us at Pulse Financial Services, is built to illustrate economic fundamentals and investment opportunities and risks. However, it's important to do it concisely. We review the Guide to the Market, different slides with all of our clients throughout client reviews, and we hand select these slides based on kind of the most current information, highest talking points, because there's over 60 pages to the guide. So what we do here is we boil it down to just 11 slides. In particular, we assess the recent performance of the markets and economy, considering trends in growth, jobs, and inflation in the US, and how these trends are shaping the outlook for monetary policy. This is followed by comments on growth from around the globe. Finally, we consider the implications of all this for those investing across asset classes and highlight the importance of getting invested, even when the markets are near all-time highs, and actively engaging with opportunities in alternative asset classes as well. At first glance, the US economy appeared to slow sharply during the first quarter, with real GDP growth falling from 3.4% annualized in the fourth quarter to just over 1%. However, after stripping out net exports and inventories, which are the most volatile major components of GDP, underlying economic momentum still looks solid, and the US economy should maintain a soft landing into 2025. Consumers have displayed impressive strength, supported by a tight labor market. That said, we do see some signs of stress. Sentiment remains suppressed, while spending on non-durable goods has slowed in recent months, a sign of mounting stress on lower-income households. Moreover, auto and credit card loan delinquencies have risen above their pre-pandemic levels. Despite this, a still tight labor market and a rising real wages should continue to offset some dwindling excess savings and tighter credit conditions, and consumers should help extend the economic expansion into next year. Business spending has been surprisingly resilient over the past year, largely due to healthy corporate balance sheets, government incentives, and surging demand for AI-related technologies. Tailwinds from AI spending in the federal government should continue to partially offset the impact of higher interest rates, although any slowdown in corporate profits could constrain growth in capital expenditures. The housing market has stabilized but remains depressed, and while elevated mortgage rates will limit any significant reacceleration in that sector, tight supply suggests a recovery in activity is more likely than another meaningful decline. International trade may be a slight drag on the economy, as a still strong dollar weighs on exports, although prospects for global growth are improving. Meanwhile, increased spending on public infrastructure and stronger hiring should support, continued support from government spending. Overall, the US economy looks set to maintain a soft landing trajectory into next year. That said, with an upcoming US election, high policy rates, and elevated geopolitical tensions, plenty of risk remain that could cause the US economy to falter. While the labor market has normalized from its post-pandemic boom, job growth remains solid in the first half of 2024. The unemployment rate edged up to 4% in May, but still marked the 30th consecutive month of unemployment at or below 4%, the longest such streak of unemployment since the late 1960s. Despite fears for an economic slowdown, strong growth in the U.S. labor supply has allowed employers to hire workers and narrow the gap between supply and demand. After falling sharply during the pandemic, labor supply in the U.S. staged an impressive recovery over the last 2 years, largely due to an increase in immigration. In fact, the fiscal year 2023 Immigration Services approved over 2 million initial applications for the employment authorization, a 70% increase from a record 1.2 million in fiscal year 2022. With the surge in migrant workers, employers were able to fill open job openings without applying upward pressure on wages, helping to explain why strong job creation hasn't sparked higher inflation. Importantly, a strong recovery in the labor force participation rate has also boosted labor supply, while continued aging of baby boomers into their retirement years has left the overall labor force participation rate below pre-pandemic levels. Participation amongst the working age population, or those age 18 to 64, has fully recovered from its pandemic losses. Moving forward, tighter labor supply, falling job openings, and solid productivity growth could slow the pace of job gains. That said, a backlog of migrant workers waiting to be integrated into the U.S. economy suggests that employment growth should remain solid and the employment rate should stay low. Inflation has made meaningful progress toward the Federal Reserve's 2% target. However, that progress has stalled in 2024, and headline CPI has been range-bound between 3.1 and 3.5% since last October. While the journey back to 2% may take longer than expected, there are still disinflationary forces that should allow inflation to resume its downward path in the back half of this year. Core goods prices have continued to trend lower in 2024 as supply chains have remained well managed, even with recent conflicts in the Middle East, and should remain well behaved. On the more volatile components, energy prices have rebounded in prices, while food inflation has remained mild. Moving forward, slow global demand limits the likelihood of a surge in either of these categories. That brings us to the stickier segments of inflation: shelter and auto insurance. Shelter inflation accounts for over a third of the CPI basket and has held stubbornly above its pre-pandemic trend. In fact, the measure has grown by 0.4% or above month to month for 7 consecutive months. That said, shelter inflation should follow real-time measures of market rent back to more normal levels. Auto insurance has been another source of hot inflation and is currently rising by over 20% year over year. Fortunately, prices here actually fell on a monthly basis in May, suggesting that pressures are improving, not worsening. As the rollover of vehicle and auto prices feed through this data, this trend lower should continue as well. Overall, inflation should continue to ease through the balance of 2024 and into 2025. While the ride down may take longer than anticipated, the Fed should feel reasonably confident that inflation can fall close to their 2% target by the middle of next year without further policy tightening. Stalling progress on disinflation has forced the Federal Reserve to reassert its hawkish tone in recent months. While the Fed continues to have a bias toward easing policy, it needs more evidence that inflation is trending in the right direction before cutting rates. At its June meeting, the Federal Reserve left rates unchanged in the range of 5.25 to 5.5% and reduced the number of expected rate cuts in 2024 from 3 to just 1, although they added 1 cut to the 2025 forecast. In its updated projections, the committee increased its headline and core inflation forecast for 2024 by 0.2% and left its growth forecast unchanged. This suggests that the committee still expects a soft landing, but also has a slower path down to its 2% inflation target. While the Fed didn't deliver rate cuts in the first half of the year, it did slow the pace of quantitative tightening. The Federal Reserve is now only letting $25 billion in treasuries mature off its balance sheet each month, down from $60 billion, while they left the mortgage-backed securities cap unchanged at $35 billion. This should leave the Fed with much larger treasury holdings than before the pandemic and help hold long-term interest rates down. Moving forward, with market expectations and the Fed messaging very much in sync, it would likely take a meaningful change in the economic outlook to trigger any sharp movement in long-term interest rates in the months ahead. After a sluggish ending in 2023, prospects for a global economy appear to be turning a corner in 2024. Countries that have done well, like the US and India, should continue to do so, while those that have lagged, like Europe, should see better times ahead. Economic surprises in Europe have turned positive in recent months, a sign of too much pessimism towards the region. Activity has been supported by higher consumer confidence due to rising real wages and stabilizing manufacturing activity. In China, the real estate slump continues to hamper growth, and while activity has gained momentum in recent months, incoming data on employment and inflation continue to look weak. That said, the fiscal support turns to focus on housing. Growth should stabilize around 5%. Elsewhere in Asia, Taiwan and Korea should benefit from renewed global demand for tech-related exports, while favorable demographics and economic reforms should continue to feed momentum into India. Overall, this year should mark a turning point for the global economy, and while the recovery may not be even across the countries, brighter times are ahead. With US consumer activity expected to slow, narrowing growth differentials should highlight plenty of attractive opportunities across the global markets. Struggled in early 2024 as investors reconsider the outlook for rate cuts. That said, as markets and the Fed expectations have converged, bonds have rebounded, and recent performance has stabilized. Still, the move higher in rates has dramatically improved the income offered by fixed income. Investors now have an extended opportunity to lock in higher yields. This slide shows how yields across fixed income sectors relative to the last 10 years, and nearly all sectors are trading well above their 10-year average yields. Simply sticking with a core fixed income provides attractive yields above 5%, while leaning into riskier assets like high yield bonds can provide yields of almost 8%. While bonds may not provide meaningful capital appreciation without any major shock, they should help diversify portfolios if lower rates coincide with a recession. Moreover, higher yields offer an attractive yield cushion that can help offset losses if rates move in any other direction. This potential for asymmetric return on bonds won't last forever, underscoring the importance of leaning into fixed income while yields are at these elevated levels. So it could be a good opportunity in fixed income. A long cycle of US equity market outperformance over international markets has left many US-based investors nervous about allocating abroad. We see this often. However, there are attractive fundamental tailwinds around the world that are difficult to ignore. In fact, well over half of the top 50 performing companies this year are located outside of the US. Slide 47 on the guide aims to highlight those opportunities that investors may be missing. In terms of earnings growth, the US has been the standout market, although prospects in other countries are improving. For example, higher wage growth in Japan could create a positive wage price spiral, which should boost company revenues and improve Japan's sleepy economy. Moreover, continued focus on improving corporate governance could generate additional multiple expansion. In Europe, stabilizing manufacturing activity and an improving economic backdrop should support earnings as well. Peak pessimism towards China appears to be behind us, and emerging market earnings estimates have improved on the back of AI tailwinds and optimism for a turn in the electronics cycle. Strong performance across international markets has pushed valuations higher over the last 6 months. However, in both absolute terms and relative to their own histories, international markets continue to look attractively priced compared to the US. Importantly, given that some global central banks have begun easing policy while the Fed is likely to remain on pause, a strong US dollar could weigh on returns for US-based investors. Even still, favorable valuations, an improving economic backdrop, and positive fundamentals should highlight plenty of opportunities around the globe. The first half of 2024 underscored the challenges facing the traditional 60-40 portfolio. That means 60% stock, 40% bonds. Stocks and bonds remain positively correlated and continue to offer mediocre levels of income. Moreover, elevated equity valuations and low bond yields relative to history point to less impressive returns for this 60-40 portfolio moving forward. Against this backdrop, investors may have to look elsewhere for consistent outcomes across alpha, income, and diversification. Investors willing to venture outside of the public markets can leverage a wide range of different alternative assets to reach their desired outcomes. Indeed, as we show on the slide 56 of the guide, alternative assets can offer low correlations to the public markets, diversified income streams, and enhance long-run returns. Real assets shown towards the left such as real estate, infrastructure, and transport, tend to be less correlated, less linked and in line to a traditional 60/40 portfolio while providing robust income. Private equity, venture capital towards the right could provide much higher total returns, but come with higher correlations to the public markets and less income generation. The classic 60/40 stock bond portfolio still looks attractive, but adding a sleeve of alternatives can still help long-term investors achieve their strategic goals through higher alpha, better diversification, risk management, and enhanced income. Resilient economic activity and solid earnings growth has powered the S&P 500 past over 30 new all-time highs so far this year. Many investors may feel that they missed the boat, leaving them on the sidelines waiting for a pullback. While investing at all-time highs can be daunting, page 64 of the guide shows that even at all-time highs, markets can still be attractive. On the left, we show the S&P 500 price index in gray and mark each all-time high that set a market floor, or an all-time high from which the market has never fallen more than 5% in green. If an investor had planned to wait for markets to retreat from all-time highs before investing, there would have been many instances since 1950 in which an investor would have missed the boat and never seen a better entry point. On the right, we show the average cumulative total return for the S&P 500 over different time horizons when investing at new highs versus investing on any given day. Importantly, returns generated from investing on any day are similar to returns from investing at all-time highs. In fact, for most of these time horizons, returns were more favorable when investing at all-time highs. With momentum playing an increasingly important role in today's market, investors sitting on sidelines should remember that strong performance usually begets more strong performance. So we thank you all for joining us. We hope you found this information important. Certainly reach out to myself or my business partner, other financial advisor, Stephanie Anderson, if you want to discuss these ideas further or learn how to incorporate some of these ideas into your portfolio, or how do these ideas match up to your retirement income strategy. We wish you all a great rest of the week.